On Thursday afternoon, the United States Treasury sold 30-year inflation-protected debt at the highest real yield since 2001. The auction was so well bid that primary dealers, the firms obliged to underwrite whatever nobody else wants, were left with 2% of it. On Thursday morning, the Panama Canal Authority announced it would cut daily traffic to 34 ships. Its lake was sitting at precisely its 5-year average for August. One asset is being handed money, the other is rationing capacity it still has. Same story, both ends. This is today's edition. Start with the bond because it is the number that reprices everything else. 2.973%. Real. For 30 years. Across all 42 auctions of this maturity, since it was brought back in 2010, none has cleared higher. The last time America sold 30-year inflation-protected paper at a better real yield was the 10th of October, 2001. Now the distribution, which is the better story. Bid to cover, 2.82. Indirect bidders, foreign central banks, sovereign funds, pension money, took 84.45%. Primary dealers, 2.10. Dealers are the residual. They get what is left after real money is filled. A 2% dealer award on a 30-year real yield auction says the liability holders turned up in size and took it themselves. And it is a real move, not an inflation one. On the 19th, the 30-year nominal fell 9 basis points, and the 30-year real yield fell exactly 9. The 10-year break-even did not move at all. 2.30, second session running. This is term premium at the far end of the discount curve, which is exactly where pension and insurer liabilities live. Now Panama. And this is where the reporting this week has been misleading, including in places you would expect better. The headline numbers are real. Advisory A29, 2026, issued Thursday. Daily slots to 34 from the 4th of September, 32 from the 15th. Rainfall across the watershed, 34% below its historical average. Inflows 44% below. Here is what almost nobody has printed. Gatun Lake, on the 20th of August, stood at 84.1 feet. The 5-year average for August is 84.1 feet. Readings across the previous 9 days ran between 84.0 and 84.2. Flat. The lake is exactly where it usually is, so this is not a shortage. The authority says so in its own document. The concern is water availability during the 2027 dry season, January to April. This is a reservoir manager spending throughput today to bank water for a drought 5 months out. And there is a second thing: the coverage dropped. While cutting the number of ships, the authority postponed 2 scheduled reductions in maximum draft. A canal in genuine distress cuts draft, because draft is what consumes depth. This one deferred the draft cuts and took the ships instead. It is trading the number of vessels against the load each one carries. That is a considered operating decision, not an emergency, and it sets a precedent that matters more than this year's queue. The canal has now shown it will ration throughput on a forecast. 3 more of the same thing, in 3 different asset classes. Bulgaria. The Kozloduy nuclear plant cut Unit 5 by about 120 megawatts on Friday, citing what it called the continuous, unprecedented and critical decline in the Danube. The plant's own words, the first time in its 52-year operating history, that unit power has been reduced for meteorological and hydrological reasons. 120 megawatts is nothing. The grid will not notice. What matters is the category. Thermal generation has been financed for 60 years on the assumption that cooling water is free, abundant, and uncorrelated with everything else in your portfolio. On Friday, at one plant, that assumption produced a D-rate. Every discounted cash flow for a riverside thermal asset contains an availability factor, and that factor has just acquired a hydrological beta. India. Official data cited this week show around 14% of solar output curtailed between April and June because transmission could not carry it. On some projects, 70 to 80% never reached a buyer. That is not a generation problem. It is a delivery problem, and it lands entirely on debt service coverage. And the United States. On Thursday, the Department of Energy announced 7 selections under the Infrastructure Act's battery materials programs, totaling $500 million. Read the stage language because it is doing the work. These are selections to enter award negotiations for up to those amounts, and the department's own condition is that a selection is not a commitment to issue an award. 2 of the 7 have no announced location. One is the entity that emerged from a prepackaged Chapter 11 last year. That is what it now costs to hold open the option of domestic mineral processing. Not to have it. To hold the option. Which brings us back to the liability side, and to the most interesting contradiction of the week. On Thursday morning, a consortium led by CVC and Prudential Financial committed up to £2 billion to expanding Standard Life's pension risk transfer business. Read that carefully too. Up to $2 billion, drawn over 5 years, $500 million of it. Standard Life's own money, completing in the first half of 2027. Nothing is funded today. And on the same morning, research from the Independent Governance Group found that just 10% of British defined benefit sponsors are now targeting buyout as soon as practical. More than 9 in 10 have reopened their long-term strategy. 40% now see the scheme as a potential source of value. 22 see it as a balance sheet risk. One caution, those findings rest on 73 respondents, not 100, and they asked sponsors, not trustees. Do not move a strategy on it. But the direction is not in doubt, and the reason is on the auction tape. At nearly 3% real for 30 years, a well-funded scheme can fund a serious share of an inflation-linked promise out of the government bond market alone. Capital is arriving to take the liability away at precisely the moment its owners can finally afford to keep it. So, what does a universal owner do on Monday? First, rerun the buyout arithmetic at today's real curve rather than the one in the last strategy paper. The comparison has moved a long way. Second, price every illiquidity premium against something with no gate. Sponsors met 53% of second quarter repurchase requests, down from 74%. One large fund's monthly subscriptions fell from $190 million in March to $16.7 million in August. The question is not whether private credit still yields more. It does. It is how much more, now that the alternative has no gate at all. Third, and this is the new one, add a throughput test to every real asset you own. For each infrastructure, utility, shipping, port, and thermal position, ask which physical input the rated capacity assumes is free and uncorrelated, then ask what the availability factor does when it is not. Water for cooling. Water for transit. Transmission for delivery. Consent for construction. None is an overlay. Each is a number inside a cash flow. One last thing, because the honest version is more useful than the dramatic one. The most striking number in the canal story is not the 34 ships. It is the 84.1 feet. A lake sitting exactly on its 5-year average, while its operator cuts traffic anyway. That is not a crisis. It is more durable than a crisis, and for a 30-year owner, more consequential. An operator deciding that a safe assumption about next January is worth paying for this September. That is the addition. The full brief, every figure and every source is on the site. Thank you for listening.